Imagine running a company, right, that is burning through cash so fast, its profit margin is currently sitting at like negative 600%.
Yeah, that sounds like a fast track to bankruptcy.
Exactly. I mean, by all normal, rational logic of the business world, you are doomed. But instead, Wall Street values your company at over $11 billion.
Right.
And on top of that, one of the most elite artificial intelligence labs on the planet just handed you a $19 billion contract.
It's just, well, it's the ultimate financial magic trick.
It really is.
And it only makes sense when you stop looking at, the software side of the AI revolution and you start actually looking at the dirt, the concrete, and the high voltage transformers required to keep it all running.
Which brings us to today's deep dive. So welcome in. Today, our mission is to unpack a really fascinating blue sky research report. This is dated July 10th, 2026.
Yes.
And we are looking at a company attempting to pull off, honestly, one of the absolute hardest maneuvers in the corporate world.
A complete mid-stride identity pivot.
Exactly. The company is TeraWulf, ticker symbol WULF.
And to be clear, this isn't just a slight change in business strategy, TeraWulf is attempting to transition from being a pure-play Bitcoin miner into, well, a vertically integrated clean energy AI infrastructure provider.
Yeah, which is, it's less like renovating a house and, I don't know, more like tearing the engine out of a freight train while it's still moving down the tracks.
It's a great way to put it.
Right, and then trying to replace it with a nuclear reactor. I mean, they're literally ripping out this highly volatile crypto mining hardware and replacing it with permanent, high-grade AI infrastructure.
Yeah.
And that financial bleeding we see on their balance sheet right now, well, that's just the cost of that mid-stride surgery.
That is a perfect way to visualize it, really, because everyone is, they're hyper-focused on the microchips right now. Like, who is designing the fastest processor? Who is writing the best code?
Right, the flashy stuff.
Exactly. But none of those chips function without actual land, massive cooling systems, and above all else, uninterrupted electrical power.
So before we get, swept up in all the AI hype, let's actually look under the hood at TeraWulf's current financial reality.
Let's do it.
Because this blue sky report, it paints a picture that is just full of extreme contradictions. So let's start with the top line. The growth is, well, it's undeniably strong. Trailing 12-month revenue is up 27.3% year over year.
Wow.
And their gross margin is a very robust 64.02%.
Which tells us, their fundamental unit economics are incredibly healthy.
Right.
I mean, that 64% gross margin means that when they lease out a megawatt of power, specifically from this early pivot toward AI and compute leasing, they are keeping a massive chunk of that revenue at the most basic operational level.
Yeah, so the core business of leasing power actually works.
Exactly, it works.
But then you move down the income statement to the bottom line, and it is just staggering. Like I mentioned at the top, we are looking at a net margin of negative 611.46%.
Yeah, that's a big number.
And a diluted earnings per share of negative $2.49. And, for anyone listening who just hears diluted EPS and their eyes glaze over,
Sure.
that simply means if you take all the company's profit, or in this case, massive, massive loss, and you divide it by every single share of stock that could possibly exist, each share is losing $2.50.
Basically.
I mean, they are burning capital at an astonishing rate.
They are, yeah. But we need to explain the mechanism behind that negative 600% net margin, because out of context, it sounds like an immediate death spiral.
Right, it sounds terrifying.
But it's actually not unusual for a heavy industrial company that's in an aggressive capital investment mode.
Right.
That massive negative number is really being driven by three specific things.
Okay, what are they?
First, equity-based compensation to attract talent. Second, the interest expense on the massive debt they took out to fund their growth.
Right.
And most importantly, massive depreciation of their physical assets.
I'm really glad you brought up depreciation. Because a lot of people, they see a negative net income and assume the company's bank account is just draining by that exact amount every single day.
Exactly, which isn't true.
Right, because depreciation is an accounting metric, isn't it?
Yeah.
It's the paper value of their massive facilities like Lake Mariner in New York and Nautilus in Pennsylvania, just slowly decreasing over time on their tax returns.
Yeah.
It's not necessarily like cash flying out the door today.
Precisely. They're building the infrastructure now before the massive waves of revenue from that specific infrastructure can actually hit the books.
Which, okay, that brings us to a valuation that is frankly, sky high.
Yeah.
TeraWulf is sitting at a market cap of $11.61 billion.
Right.
Their price-to-book ratio is 82.66. And just to put that in perspective for you listening, the price-to-book ratio basically compares what the market values the company at versus the actual liquidatable value of its physical stuff.
Right. The buildings, the land, the servers.
Exactly. So an 82 means the market is pricing the stock at 82 times the value of the actual physical assets sitting on the balance sheet. And their price-to-sales ratio is 69.07.
Yeah, so the market clearly does not care about the tangible assets currently on the books. I mean, they are completely ignoring the present reality.
Yeah.
Instead, they're pricing in the intangible growth optionality. They're valuing the AI leases TeraWulf is signing, their long-term power purchase agreements, and their exclusive rights to expand on their current real estate.
I have to push back here, though.
Sure can.
With a price-to-sales ratio of 69 and those deeply negative net margins, isn't the market pricing this company for absolute perfection? I mean, they are operating with the cash burn of a risky early-stage startup, but they are being valued as if they are already an established, dominant tech giant.
It is a massive premium, no doubt. But to understand why institutional money is, willing to pay that premium, we have to look at the competitive moat surrounding TeraWulf. And that moat is clean power at a scale that almost no one else can offer right now.
Yeah, the Blue Sky report actually leans really heavily into this. Both the Lake Mariner and Nautilus facilities, they run entirely on zero-carbon power sources. We were talking predominantly hydro and nuclear power.
And in the current landscape, that zero-carbon footprint is everything. I mean, the hyperscalers, the Amazons, Googles, Microsofts of the world, and the elite AI labs, they are under immense pressure.
Oh, totally.
From their shareholders and from government regulators to really reduce their Scope 2 emissions.
Let's define that real quick for the listener. So Scope 2 emissions are the indirect greenhouse gas emissions associated with the purchase of electricity.
Right.
So it's not the emissions from, your own company's factory smokestack. It's the carbon footprint of the power you buy from the local grid to run your operations.
Exactly. And if an AI lab wants to train a massive next-generation model, it takes gigawatts of power.
Huge amount.
Right. So if they buy that power from a traditional grid that's heavily reliant on coal or natural gas, their Scope 2 emissions just explode.
Yeah, it becomes a massive public relations and regulatory nightmare.
Exactly. But by partnering with TeraWulf, these AI labs become compliant by design.
So it creates incredible switching costs for the tenants then.
Oh, and not just switching costs, but a total lock-in.
Right.
I mean, if a tenant leaves TeraWulf, they don't just lose their power source, they lose their ESG compliance status.
Oh.
They literally cannot easily find this scale of carbon-free power anywhere else in the country right now.
And there's also a massive time to market advantage, right, which the report highlights. Getting new grid interconnection capacity in the United States currently takes anywhere from 3 to 5 years.
At least.
Yeah, and it's important to understand the why behind that delay, because you can't just buy a plot of land, build a gigawatt data center, and, plug it into a standard power line on the street.
No, definitely not.
You need custom, massive, high-voltage electrical transformers. And right now, the global supply chain for those specific transformers is so backlogged that if you order one today, it won't arrive for years.
Years. It's crazy.
Plus, the local utility has to approve it, the regional grid has to physically handle the load, and the permitting lines are just miles long.
That's just the crucial bottleneck.
Right.
But TeraWulf already has these pre-permitted, fully powered sites. Their real estate is incredibly scarce and practically non-replicable in the short term.
Right.
In the AI arms race, waiting 3 years to power up your data center just means losing the race entirely.
This actually brings up a huge conceptual point that I just found it fascinating in the research. Bitcoin mining and AI data centers are actually financial and physical opposites.
How so?
Well, Bitcoin miners need cheap, intermittent power. If the grid gets stressed and electricity prices spike, a Bitcoin miner can literally just turn off their machines for a few hours.
Yes, their operations are highly flexible.
Right. But AI data centers, they need 100% always-on, ultra-reliable power. You cannot turn off a server farm in the middle of training a multi-billion parameter AI model just because it's a hot day and grid prices went up.
Right, it ruins the entire computational run.
Exactly. The real insight here isn't just that TeraWulf is pivoting, it's that TeraWulf's specific power sources, nuclear and hydro, are literally the only energy sources capable of bridging that gap.
Yes.
Solar and wind are too intermittent for AI. Coal and gas ruin your carbon footprint. Nuclear and hydro are the only 247 zero-carbon options that allow a company to transition from intermittent crypto mining to permanent AI infrastructure.
That is the core of their entire valuation. I mean, they hold the golden ticket in the energy transition.
Okay, so if they have this ironclad power setup, how do they actually capitalize on it to justify that $11 billion valuation? I mean, that leads us directly to the transformative, sector-defining catalyst, doesn't it?
Oh, absolutely. The $19 billion contract.
Yeah. According to the report, TeraWulf recently signed a 20-year lease with Anthropic. For context, Anthropic is one of the world's most elite AI labs. They're responsible for the Claude family of models.
Right.
And this deal represents an estimated $19 billion in total contracted revenue over those 2 decades.
This is the exact moment the identity pivot becomes a reality. I mean, moving from a Bitcoin miner to fulfilling this Anthropic lease, it fundamentally changes the financial DNA of TeraWulf as a business.
Because Bitcoin mining is entirely speculative, right?
Yeah, exactly.
Your revenue depends on the spot price of Bitcoin and the global hash rate on, like, any given Tuesday. You can't model out your cash flow for next month, let alone next year.
Exactly.
Yeah.
But a 20-year lease with a hyper-funded, credit-worthy tenant like Anthropic, that converts TeraWulf into a legitimate infrastructure business. It gives them investment-grade, REIT-like cash flows.
REIT meaning real estate investment trust for the listeners.
Exactly. It becomes predictable, stable, utility-like income.
And there are massive secular tailwinds backing this up, too. We just saw OpenAI release GPT 5.6, which proves that model scaling is only accelerating.
Yep.
The models are getting bigger, requiring vastly more compute, which obviously demands more physical space and power. We also saw competitor Applied Digital just sign a parallel hyperscaler lease.
Which is huge.
Yeah, it proves it's not just an isolated fluke for TeraWulf. You know, there's an industry-wide scramble for powered real estate.
Definitely. And the report also contextualizes this with a recent macro event, the massive Telstra infrastructure outage in Australia.
Oh, right. Yeah.
While Telstra isn't related to TeraWulf directly, that outage, which was caused by a failure to replace aging physical infrastructure, serves as a stark reminder to the global market.
Yeah, you cannot run the digital future of human intelligence on 50-year-old grid technology.
Precisely. If we are going to trust AI with critical enterprise and societal functions, the physical buildings housing those models cannot be vulnerable to standard grid failures.
But here is where I get hung up, honestly.
Okay, what is it?
Bloomberg reported that this dedicated Anthropic data center is going to require approximately $3.5 billion in capital expenditure to actually build. $3.5 billion.
Yeah, it's not cheap.
TeraWulf has a negative net margin of 600%. How on earth do they finance a $3.5 billion build-out without issuing millions of new shares of stock and diluting their current shareholders to absolute zero?
It is the central tension of the stock, no doubt. But this is exactly where the mechanics of that 20-year contract work their magic.
Okay, how?
Because they have a $19 billion legally binding lease with a premier company, they can take that contract to a massive institutional lender and use it as collateral.
Oh, so they leverage the future revenue to pay for the present construction.
Yes, exactly. They can secure project-level debt, they can enter into a joint venture, or utilize like a sale-leaseback structure.
Yeah.
The contract essentially de-risks the financing.
Right, that makes sense.
If you walk into a major investment bank and say, hey, I need $3.5 billion today, but I have Anthropic legally bound to pay me $19 billion over the next 2 decades, well, the bank is going to happily underwrite that loan. The cash flow is already spoken for.
So if they have this ironclad path to financing through the Anthropic deal, how is Wall Street actually digesting that risk in real time? Are the algorithms, buying the stable infrastructure narrative, or are they still treating this like a volatile crypto stock? Let's look at the chart.
The price action is really a perfect reflection of this identity crisis.
Looking at the live data from the report, the stock closed at $23.20. Over the last 52 weeks, it is up an incredible 370%.
Huge run.
But it's currently sitting 22.3% below its recent high of $29.84.
Yeah, and that 22% pullback tells us we're in a classic period of consolidation. The market digested the initial euphoria of the Anthropic news, drove the price up near 30, and is now kind of taking a breath, waiting to see the exact terms of how this $3.5 billion will be financed.
The trading volume backs that up, too. It's sitting at 1.35 times its 3-month average. The report labels it, buy the rumor, sell the news, reaccumulate behavior.
Classic.
But there is a metric here that absolutely fascinates me, and it's the beta. TeraWulf has a beta of 3.75. For anyone listening who doesn't, obsess over stock charts, a beta of 1 means the stock moves exactly in sync with the broader market.
Yeah.
A beta of 3.75 means if the S&P 500 goes up 1%, TeraWulf historically shoots up almost 4%. And if the market drops 1%, TeraWulf plummets 4%. It is violently volatile.
It's swinging wildly on any given day.
Which brings up my main skepticism again. How does a beta of nearly 4 make any sense for a company that is supposedly transforming into a stable, predictable, REIT-like infrastructure play? The stock is moving like a roller coaster. Is this really realistic for a utility-style business?
It's not realistic for a mature utility, no, but it is entirely realistic for a company in transition. The reality is that the market hasn't fully re-rated the company yet. The stock is still trading with the legacy volatility of a Bitcoin miner, combined with the speculative frenzy of a high-growth AI stock.
I see.
It takes time for an investor base to physically turn over. The crypto day traders who love volatility have to slowly cycle out, and the slow and steady infrastructure pension funds have to cycle in. Until that transition is complete, the stock is going to remain a roller coaster.
Well, the institutional analysts seem to think the ride is headed up. Morgan Stanley's Stephen Bird just maintained his overweight rating on the stock and raised his price target to $72.
Which is huge.
Yeah, that implies a massive 210% upside from current levels.
Morgan Stanley is looking past the current messy capital expenditure phase. They are modeling out what this company's balance sheet looks like years from now when the Anthropic facility is fully operational and just printing cash.
And broader sentiment really reflects that optimism. The report analyzed the top financial news stories surrounding the stock, and the sentiment ratio is 4-to-1. Strongly bullish. The narrative is heavily weighted toward the transformational nature of this $19 billion pivot.
But as with any investment thesis, especially one dangling a 210% implied upside, we have to flip the coin.
We do.
We need to look at the bear case. What are the immediate red flags and systemic risks that could derail this entire narrative?
There are definitely some significant ones. The most glaring red flag to me is the insider selling. Over the last 90 days, insiders at TeraWulf have sold a net 5.84 million shares. And it wasn't just one big dump. This was spread across 47 different sell transactions.
That is absolutely a yellow flag, and one that requires us to look at the context of executive compensation and, well, human behavior.
Because if you are a TeraWulf executive and you truly believe Morgan Stanley's $72 price target is a realistic destination, why on earth are you cashing out nearly 6 million shares at $23?
It's the multi-million-dollar question, right? But let's add some perspective here. Remember, the stock is up 370% in a single year.
Sure.
If you are an executive who has been grinding away at a highly volatile crypto miner for years, and the vast majority of your personal net worth is tied up in this single stock, well, taking some chips off the table after a 370% run is statistically very normal.
Just cashing in a bit.
Exactly. It is prudent financial diversification. Many of these sales are likely scheduled months in advance through automated trading plans.
So 47 transactions spread across multiple insiders is actually much better than one single executive dumping everything.
Yes, entirely. If the CEO or the CFO suddenly sold 90% of their personal holdings in one unannounced block, that is a 5-alarm fire.
Right.
But distributed scheduled selling after a massive multi-bagger run is standard corporate behavior. Doesn't necessarily mean they lack faith in the $72 target. It just means they want to buy a house in cash today.
Fair enough. Fair enough. But what about the sector headwinds?
Yeah, let's talk about those.
The stock recently suffered a 14% slide, and the narrative driving that drop was a combination of threats. Meta announced they were pushing for more in-house cloud capacity, meaning they want to build their own infrastructure rather than lease it from companies like TeraWulf.
Right.
Then DeepSeek released new, vastly more efficient AI chips that simply require less compute power to achieve the same results.
Yep.
And on top of that, a broader drop in crypto prices dragged WULF down due to its legacy mining operations.
And we really can't ignore the macro risks the report cites either. Geopolitical tensions, specifically the deterioration of the Iran ceasefire, pushed oil prices above $80 a barrel recently.
Yeah, and when oil spikes, inflation fears return.
Exactly. Interest rates stay high, and the broader market rotates away from highly valued, capital-intensive growth stocks.
So you have the macro environment turning hostile, AI hardware getting more efficient, and tech giants wanting to build their own data centers. I mean, that is a formidable bear case.
It is. But this is where the specific mechanics of the Anthropic contract prove their worth yet again. That 20-year lease is locked in.
Right.
It is completely immune to short-term fluctuations in chip efficiency. If DeepSeek's new chips use 20% less power, Anthropic is still contractually obligated to pay TeraWulf for the capacity they leased.
They bought the space and the power regardless of how efficiently they use it.
Exactly. And regarding meta building in-house, there is just so much raw demand for compute right now that no single tech giant can build fast enough to satisfy their own needs.
That makes sense.
The secular tailwind of model scaling like GPT 5.6 completely dwarfs the near-term noise of chip efficiency.
So where does this leave us? Let's summarize the Blue Sky Research Report's final verdict. They give TeraWulf an 8 out of 10 bullish score. They view it as a multi-year hold, specifically, a 12 to 24-month horizon.
Which aligns perfectly with the reality of heavy industry. Buildings take time to build. Transformers take time to ship.
The core thesis is that investors need to wait for the market to slowly re-rate the company's valuation metrics. I want to touch on this because it's vital. Right now, it's valued on a price-to-sales multiple, which is essentially how you value a software startup that has revenue but no real reliable profit.
Right.
But once those Anthropic revenues kick in and the financing structure is solidified, the market should transition to valuing TeraWulf on a forward EV to EBITDA multiple.
And for context, EV to EBITDA is a metric that looks at the core cash the business generates from its actual operations.
Stripping out all the noise.
Exactly. Completely stripping out the accounting noise of taxes, debt, interest, and that massive depreciation we talked about earlier. It is how Wall Street measures a stable, mature, cash-flowing business.
It's the ultimate graduation from a volatile startup to a blue-chip utility. And of course, we always have to remind you listening, this is an analysis of a specific research report.
Yep.
This is an exploration of their data and their thesis, not financial advice for your portfolio. Always do your own research.
But this is exactly why this deep dive matters. Even if you never invest a single dime in the stock market, TeraWulf's story is a window into the raw, physical reality of the AI revolution.
We often treat artificial intelligence like it's a magical, invisible resource that just lives in the ether of our phones. But this report proves that the cloud requires massive, unprecedented amounts of land, concrete, cooling pipes, and clean power.
The digital future is going to compete directly with our physical present for the exact same resources.
Which leaves us with a pretty provocative question to chew on as we wrap up. If you look at the national landscape, the hyperscalers and the elite AI labs are aggressively gobbling up 20-year exclusive leases on all the available zero-carbon hydro and nuclear power across the entire country.
It's true.
TeraWulf is just one example of a massive trend. So if the tech giants buy up all the clean energy before it even hits the open market, well, what does that mean for the local power grids in those regions?
Yeah.
And more importantly, what does that mean for the monthly energy bills of everyday people living in those communities?
It's a fascinating tension. I mean, the cost of artificial intelligence might just show up on your local utility bill.
The AI gold rush. It turns out, even in the cloud, someone still has to swing the heavy machinery, and someone definitely has to pay for the electricity. We'll leave you with that thought. Thanks for joining us, and we'll catch you on the next deep dive.